If you've been investing for any length of time, you probably noticed something strange has happened over the past few years. Traditional portfolios don't feel as reliable as they used to. The old stocks and bond portfolio isn't quite delivering the same performance as it used to because countries have been dumping US bonds in recent years. And since that main event that happened 6 years ago, you all know what I'm talking about, inflation keeps showing up in waves. So investors are doing what they always do in uncertain periods. They're looking outside the traditional playbook as they look to keep up with inflation and target better returns than a set it and forget it model that was popularized for 30 years. So in this video, I'm going to walk through the three alternative asset trends that are clearly gaining traction. And what we're going to be talking about is precious metals, Bitcoin and preferred income style alternatives, and algorithmic trading systems. Not just how to trade them, but why investors are allocating to them, what role they play in a portfolio, and what expectations actually make sense. So let's dive in. So the first thing that we're going to cover is precious metals. Now, precious metals are probably the least exciting alternative on the list, and that's exactly why it's coming back in a big way into portfolios. See, gold and silver, they weren't really designed to be growth assets. The physical metal itself doesn't actually produce any income. What they really are is insurance assets. See, investors turn to precious metals when inflation risks feel persistent, which they are right now. The currency that the government is printing continues to weaken, so the confidence weakens as well. Or overall, just trust in the financial system starts to erode. And what's important about this is that the expectations have changed. See, nobody was buying gold thinking that it was going to beat the market. But if you actually look at the past 20, 30 years, gold has outperformed the S&P. Now, this is where we get into Bitcoin as things become more modern. See, Bitcoin has been mostly misunderstood by investors because, quite frankly, in my opinion, I think a lot of Bitcoin's volume was actually the gold trade, but because gold was suppressed for so long by institutions, Bitcoin and us as humans found a way to create something similar to get around all that manipulation going on in the gold market. Now, with gold, as we know, there's ETFs, there's gold income funds, and other vehicles for exposure to that commodity. But recently, for digital assets, this is where Bitcoin digital asset treasury companies that issue preferred stock alternatives are becoming lumped together because they both play outside the traditional equity beta thinking, and they definitely play different roles than a traditional active company. So let's start with Bitcoin. Some investors, including myself, treat it like a digital gold, while others see it as a speculative tech asset. But increasingly, allocators are treating it as a non-sovereign, asymmetric hedge, not because it's stable, because we obviously know it isn't, but because the drivers are fundamentally similar to gold, but different from stocks and bonds. See, Bitcoin tends to respond, just like gold, to monetary policy shifts, liquidity cycles, and long-term adoption narratives. Now, that volatility is essentially structural and is typically uncorrelated with most assets, even though there is a lot of correlation with it with the NASDAQ. But that alone wasn't giving investors a reason to invest into Bitcoin. See, for traditional investors, since they're used to ETFs, stocks, preferred stocks, they didn't really have a massive allocation to Bitcoin, partly because you had to jump through a bunch of hoops and stuff in order to actually buy it. But that's where companies like Strive, Strategy, and these other digital asset companies come into play. Because what they are doing is actually fundamentally different. They're providing yield in the form of an ETF or preferred stock without giving them exposure to Bitcoin directly. They're also providing less duration risk than traditional bonds. They're keeping things a bit more predictable because they're siphoning off cash to give to the investor from the Bitcoin ecosystem. See, these securities are helping reshape risk around Bitcoin, which obviously gives the investor optionality with Bitcoin. It gives them a preferred style asset for smoother income, and it's really just a different tool. And you can go watch Michael Saylor's videos on their preferred, equity and their preferred stock models, how it's disrupting that market. But the point is, this is a product that uniquely can be offered now because the traditional bonds have been underperforming for so long that people are considering some of these higher risk bonds that are even Bitcoin backed. Now, a lot of investors still may never touch gold. They may never touch gold mining. They may never touch Bitcoin mining, or these other products that provide income because they're used to trading volatility. They don't want any exposure to a commodity. They may just want exposure to, again, the volatility. And that's where the newest, most misunderstood alternative on the list lies. And I'm talking about algorithmic trading systems. Now, they're not magic or anything like that. They're mostly passive, but not quite fully. And investors are increasingly allocating to them for one simple reason. They behave like independent return streams. So instead of having to rely on economic growth and GDP prints, the newest up round in a valuation or VC deal, or interest rates changing directions, these systems simply rely on rules, probabilities, and repeat that system over and over. So they aim to capture trends, they aim to capture mean reversions, they aim to capture volatility shifts itself. Now, what matters to investors really isn't the code itself, it's the behavior and the performance and in what periods it actually performs well in. So let's go over some of the standard performance that algorithmic systems often provide. They typically perform very well during volatile periods. They typically extract profits, especially during choppy times and directionless markets. And depending on which strategy you've chosen, you can typically have better management with trades due to the tight stop losses and drawdown protections, which is what's attracting a lot of investors to this space overall. Now, that makes them not necessarily a nice to have anymore. They're basically a need to have if you're looking for alpha, trying to extract profits from the markets without having to stay at the computer all day staring at charts and hoping that your pick actually went the right way. See, for context, in a portfolio, algos are not about replacing stocks, replacing gold, or replacing Bitcoin. They're about reducing dependence on one single market and being able to cash flow or compound profits with them. See, a lot of the business owners and investors that I speak with that are considering our algos or others that are on the market, they typically think they're the same. While ours have been, third-party vetted and third-party verified, there are others out there that are in beta, they're still in backtests, and are not quite ready for the market. So what you really want to find is stuff that's independently verified, has a track record, because the ones that have been in the markets for a long time, that actually have gone through stress tests, are the ones that can actually have deployed capital, or a lot of the ones in beta and a lot of the ones that were only on back tests, they really fall apart when you actually deploy them. But overall, just to be very clear, algorithms aren't designed to win every single trade. They're not going to just have a smooth line straight up in your portfolio. You see, you'll have some losing trades, and ultimately, depending on the strategy that you've selected, you just want to ensure that you have strong performance and you're able to see that growth over time. But when you select the right algorithms and allocate accordingly in your portfolio to them, they can again offset equity drawdowns, they can add an uncorrelated performance stream to your portfolio, and they can help you drive performance of your portfolio over time. And see, this is why institutions have used systematic trading strategies for decades, and why retail investors are now finally starting to pay attention to this. And look, if you don't believe me, check this out. Chances are you didn't know that JP Morgan has been offering algorithmic trading services to their highest echelon clients for many years. So really the purpose of this video was to tie in these three alternatives together, because it isn't just about performance anymore, it's actually changing the way that your portfolio is functioning. Bitcoin and precious metals are protecting your purchasing power over time. Bitcoin and proxy income alternatives are reshaping risk and return specifically for the bond market and for people looking for consistent yield. And algorithmic trading systems introduce independent return drivers that are actually keeping drawdowns very tightly. Now look, none of these are silver bullets, but together they're reflecting a larger shift. Investors are no longer depending and asking themselves, how are my stocks doing? They're asking what outperforms when the traditional system starts to break. And that mindset is the real trend. And look, the future of investing isn't about finding the next asset to jump into. It's about building portfolios that can survive multiple futures, not just one. See, alternatives typically are not about being clever. They're about being prepared for any type of outcome and allocating accordingly. So if you want to understand how our algorithmic trading systems actually fit inside of portfolios, the expectations, the sizings, and the long-term behavior, and there's a link in the description that you can actually click on to go book a call with our team. However, if you found this video valuable, then go ahead and like and subscribe, and I'll see you in the next video.